So இதில் வந்து we are going to see about the vicious circle and virtuous circle. What is vicious circle? What is virtuous circle? The factors that keep on reinforcing themselves to lead to a positive outcome is known as virtuous circle. For example, if there is a high employment, it will lead to increased productivity, and this will lead to increased growth, which in turn reinforces higher employment. This is known as virtuous cycle. அதே நேரத்தில் விஷியஸ் சைக்கிள் என்னன்னு பார்த்துட்டோம்னா, the factors that reinforces themselves to lead to a negative outcome. Here positive outcome, here negative outcome. This is the difference. For example, if there is an increased unemployment rate, it will lead to decreased productivity and lower the growth rate, which in further in turn increase the unemployment rate. And we also see about the national incomes. National income, types of national income, how to calculate GDP, new methodologies in GDP calculation, GDP deflator, per capita income, pro and counter cyclical growth, vicious and virtuous cycle we have seen already. Now the types of national income: gross domestic product, gross national product, national domestic product, national net national product, and national income. Net domestic product, net national product, national income. GDP, it is the monetary value, that is rupees, in rupees, of all goods and services. Rupee value of all goods and services produced within a geographical area, within a period of time. Suppose if we consider India as the geographical area, the amount of the monetary value of all the goods and services produced within the territory of India in a given period of time, usually a monetary year, financial year, this is known as GDP. There are three methods of calculating the GDP. Number one is output method or product value method, income method, and expenditure method. Output or product value method, it is the output into market price. Output product into market price of 1 unit. Income method, it is the sum of all factor incomes. Expenditure method, it is equal to C plus I plus G plus X minus M. It is the sum of all expenditures made. Consumer spending, C is consumer spending, I is investment, G is government spending, X is export minus import. This is the expenditure method. National income. National income, it excludes the services, household services. It excludes the black money, transfer payments, goods made for self-use, and old goods. In calculating national income, we should subtract all these things. How to calculate GDP? If there is a goods and services produced, it needs factors of production. These factors of production are land, labor, capital, and entrepreneurship. So for getting these factors of production to a place to put so that production can be set up, the company needs to face some cost in the form of rent for land, salary and wages for labor. Capital, they should pay interest, and entrepreneurship, it will get profit. So if we add all these things, cost, then it is total cost of production. At the same time, the income earned by the service or goods provider. That is the factors of production providers will get income during this period. It is comes under revenue to the provider of land. He will get rent. The labor will get salary, wages, income, and the capital will get interest. Entrepreneurs will get profit. While adding all this total income, we will get total income received. Calculation. So we can calculate all GDP with the help of GVA at basic price plus net tax, and also by expenditure method. It adds all the expenditures, and we will be getting GDP. New method of measurement. The base year was changed from 2004, 2005 to 2011 to 2012. SNA was a System of National Accounts. It was established by United Nations in the year 1992, and it was 2008. It was regularized by World Bank, IMF, Organization of Economic Development. SNF. Methodological changes. MCA 21 data are included. Cost price to market price was taken. GVA, gross value added methodology, is used. What is gross value addition? Value added is equal to total consumption minus consumption of the intermediate goods. That is the value added. For example, if there is a raw material, steel, it is converted into a rail track. So for conversion of this, there is a value addition is seen. So the total consumption minus consumption of the intermediate goods is known as value addition. Then we will be seeing about production tax, production subsidies, product tax, and product subsidies. Production tax, it is the taxes on the production process. Example, land revenues, stamps. Production on the factors of production, land revenue, stamps, registration fees, professional tax, etc. Production subsidies, these are the subsidies that are given to the factors of production. Railway input subsidies to farmer, subsidies given to small individuals, industries, subsidies given to companies. What is product tax? The tax that is levied upon per unit of the product dependent on the volume of goods produced is known as product tax. Example, excise tax, sales tax, service tax. What is product subsidies? The subsidies given per unit of the product produced. For example, petroleum subsidies, fertilizers, farmers subsidies, etc. What is basic price? Amount received by the producer plus tax minus subsidies is known as basic pay. So GVA at basic price is equal to gross value addition, where GVA at base price is equal to GVA at factor cost plus production taxes minus production subsidy. GDP is equal to GVA at basic price plus product tax minus product subsidy. What is potential GDP? Potential output when there is full employment, growth is sustainable, aggregate demand does not exceed the aggregate supply, then it is known as potential GDP. As the economy uses its resources efficiently, policy making can help in addressing the output gap. Factors affecting the potential GDP: inflations, low productivity, unemployment, factory output, and infrastructure. What is GDP deflator? It is used to adjust for inflation. WPI, WPI price index. It is used in India. PPI, producer price index. It is used in developed countries. Government of India set up a committee under B.N. Goldhar. What is GDP deflator? It is the nominal GDP by real GDP. Goldberg Committee recommendation: supply use of 2011 to 2012 table may be used for supply purpose. Two sets of PPI are prepared, including the services. Producer price index, including services and excluding the services, needs to be prepared. Production price index should replace WPI after stabilization of the series. Working group recommended inclusion of 15 services in PPI basket to begin with. Experimental PPI released on monthly basis. Initial base year for experimental PPI is 2011 to 2012. Here 2011 to 2012. Gross national product GNP is equal to gross domestic product plus net factor income from abroad. It excludes the income generated by the foreign nationals who residing in the country. Consider income generated by the citizen of a country present within or abroad the country. Normal resident of the country within a financial year. Net factor income from abroad. Net compensation for employees, net income from entrepreneurship and property, net retained earnings of the resident companies abroad. What is net domestic product? Subtracts the value of depreciation of the capital assets of the nations with such as machinery, housing, vehicles from GDP. NDP is equal to GDP minus depreciation. Net national product NNP is equal to GNP minus depreciation. National income is purest form of national income is NNP, net national product minus indirect taxes plus subsidies. It includes depreciation. It take into accounts the depreciation of the capital, indirect taxes and subsidies. Limitation of NNP national income: non-availability of data, time lag, existence of non-monetized consumption, parallel economy, do not consider the development and environmental impact. Per capita income. Per capita income, it is the national income divided by population. It is just an average. Do not show the contribution of the various sectors. Standard of living is affected by the government expenditure, usually expressed in dollar. Now let us see about the economic cycle. It has a 4 phase: boom or expansion phase, slowdown phase, recession phase and recovery phase. Boom: pro-cyclical policies, government policies to reinforce the phase in the cycle. What is counter-cyclical policy? Government measures act against the phase in the cycle. For example, when there is a recession, that is GDP is decreasing. If the government follows the contractory policies, that is decreasing the government expenditure and increasing the taxes, then this is called pro-cyclical. And while during expansion, increasing GDP, if the government increases its expenditure and decreases tax, it is called pro-cyclical. Whereas it is vice versa. When there is a recession and the government follows an expansionary fiscal policy, increasing expenditure and decreasing taxes, and during the expansionary phase, if the government decreases expenditure and increases taxes, it is counter-cyclical policies. Pro-cyclical policies deepens the recession, amplifies the expansion, increases fluctuation in the business cycle. Counter-cyclical softens the recession, moderate the expansion, decreases the fluctuation in the business cycle. We have already seen vitreous and vicious cycles. We will be seeing about the type of recoveries in the next videos. K-shaped recovery, U-shaped, V-shaped, L-shaped, Z-shaped, J-shaped, and shoe-shaped, inverse square root shaped.